What's up, traders? How does implied volatility affect our trading when we are doing premium selling strategies like iron condors, credit spreads, straddles, strangles? This was a question that was posed to me by a member of my Discord, and I wanted to answer it here for him and anyone else to show how it's important and how it affects trading results when you're employing these strategies. So, what is implied volatility? It's basically what the market expects the move to be, and it prices options accordingly. People are buying and selling options all the time for a certain price, and that is what they are pricing the probability of this happening. Now, how does this affect our premium selling strategies? Well, we want there to be a lot of implied volatility because that creates a big spread. Either we can get more premium within a certain range that we want, or we can take these strategies further away from the current stock price and possibly increase the probability of success. Let's look at some of the nerd stuff of why this works, and then I'm going to use some practical examples to show how this affects trading from a trade to trade basis. So we're going to use Microsoft as our test. And right here, how implied volatility is used in a formula to calculate standard deviation is right here. Okay. So don't need to remember this for the purposes, but this is going to give some background on why it works the way that it does. Basically, got a calculation in here that I've done. The current stock price, closing price of Microsoft today is 284. The implied volatility that I see in the Thinkorswim platform is 33.55%. Now, what this is the 30-day implied volatility. And that's what is calculating there. So it's the one standard deviation is 2731. What this is the range plus or minus either 2731 above or 2731 below 284. That's what the market predicts this stock will be in 30 days from now. Now, how you can visualize this on a probability graph is this in Thinkorswim. And remember, we were looking at about 30 days out, which is right here, happens to be the 29th of October expiration. So the current price is 284. And remember that the up or down was 2731. So right there at the 30-day, we can see that's showing us within the probability curve, the bell curve there, that the upside would be 31.18. It probably varies from my calculation of this one because of the after hours data, but very, very close. So that is what it is showing us. Now, in Microsoft, when we look at implied volatility, and this indicator down here is a script that I wrote in Thinkorswim. Actually, I didn't write it. Props to the Tasty Trade folks for initially writing it. I added the color coding, but you can see the implied volatility changes a lot, especially over the last 2 years. We had the COVID crash, which really rose volatility to some very, very high levels. And then it has a sort of sinusoidal nature, kind of returning to the mean a lot, oftentimes raising up before earnings. And so it changes. And so we need to be aware of these changes and what they mean if we are selling options, if we're selling premium, or if we're buying for that matter. But let's look at the difference and what happens when IV is high versus IV is low. The yellow line's the average right here, calculated over the past year. And so on 5/12, May the 12th, 2021, we had a very high IV day. It was above average, okay? So let's use the platform here, Thinkorswim, another great tool. I don't get paid to advertise for them. I just think it's a great software platform. If you're going to be serious about trading options, you need to have this data available to you some way, somehow. Also like the Tasty Works platform as well. So I don't sponsor either one of them, but you need these tools. Okay. So with $239 at the closing price on 5/12, let's just say that we want to take this about 10 strikes out, or 9, as the case may be, close as we can. So we're going to sell a bullish put credit spread. And so if we did the 230, sold the 230, bought the 225, roughly based on the closing price, we would have gotten $1.25 in premium on this day. Okay, so remember that's about $9 away. Now let's look at a low IV day. So roughly a month later, on 6/11, we had a very low IV day. So let's see what happens if we try to take a credit spread on that day. So 6/11. Now it's 257. We can't quite get 9, but it's close to 8. Let's just do the 250. It's pretty close. Oh, I need to put it in the right. There we go. Okay. Close to 30 days. All right. So 250. We're going to sell this bullish put credit spread. And look, we're not that far off. We assumed that $9 away, or roughly $10 away from in the money, the spread was, we would get less. Because when IV was higher, you got more premium. When IV was lower, to put on that same distance trade, you just got less credit. And this affects your profitability as you go along. Now, what if you were fixated on getting over $1 in credit? Well, you can do that on this date. We could go closer to in the money, sell a spread here, and now there we can get above that level. We can get above $1. But notice, to achieve that, we had to go closer to in the money. And that means if the stock actually does pick up some momentum, if it actually does increase in volatility, well, we could get burned on this. So what implied volatility allows us to do is either one of two things. It lets us take our sold strikes further out, give us a wider range for that stock to play around in. Or if it's high, we can keep the same range, keep it close to the at the money, and make more premium. And it's really that kind of a double-edged yin yang of options trading. You got to figure out which one is going to be the best for your strategy. Are you going to go for high probability, high premium? Can't have both. It's a seesaw. It's a pulley. So if you like using this particular indicator, I'm not going to charge you for it. Join the Discord, ask for it. It'll be open source to whoever wants it. Really good for identifying these moments of high IV and low IV to avoid. There is an estimation on TradingView. This is the Implied Volatility Suite written by the user Sega RKO. It is somewhat imperfect in that it's estimating implied volatility of underlying stocks based on their historical volatility. It can be used for this purpose. I like that they've integrated IV rank and IV percentile in here, but again, it's not really showing you true implied volatility. You're going to need to use a platform for that. Hopefully, eventually, TradingView can add this feature. Maybe a paid service to pay for the data, but it'll be worth it if you're serious about your trading. So, hope this answers questions, gives you all something to think about. Trade wisely. We'll see you in the next video.